Hey, welcome back everyone. So my name is Zach Vines, and today we're going to go over one of the most fundamental parts of accounting that we tend to struggle with a little bit when we first learn it, because many of us tend to think about revenues as synonymous with cash coming in and expenses synonymous with cash going out the door. Well, let's think for just a moment. In the 21st century in modern day business, if you're going to go somewhere and they don't accept anything but cash, you have to have cash going in the door, odds are they're probably not going to get everyone's business, right? That's a deterrent for a lot of people. Big companies pretty much work the same way. Believe it or not, very big companies don't tend to have enormous surpluses of cash on hand at any given time that they're just going to pay all of their bills with. They're going to buy inventory. They're going to buy all these things immediately with cash. That doesn't happen as often as you may think, even though these companies are big and they make a lot of money. You think about money as being physical dollar bills. Oftentimes that's just going to be considered revenue. So kind of carry that logic through when we talk about accrual accounting, kind of just to start with. So basically what accrual accounting all boils down to is that we're going to recognize some sort of transaction right now, but we're not going to recognize the cash quite yet. So you'll hear about accruals and deferrals. You can think that with accruals, the cash comes later. Deferrals, the cash comes now. We're not going to talk about deferrals quite yet in this video, but to kind of talk about accrual accounting, when we're saying we're selling a product. So let's pretend that we are a company selling a product to a customer to start with. The customer comes up to us and they say, hey, I want to buy this product, but I don't have the cash on hand right now. Well, you as the company, you don't want to just turn away a sale because they don't have cash on hand. Then you would be like the people we just talked about a moment ago, where you show up, they only accept cash, and then you go, oh, I don't have cash, and then they walk out the door. They still want your business, but they're going to accept the fact that, okay, well, you may not have cash right now, but let's go ahead and make this transaction happen. Hey, I'll put it on your tab. Pay me in cash later, it's fine. And you want to be smart about it. You don't just extend credit and do accrual transactions with people you don't think are going to pay you back. But at the same time, you're missing out on a huge customer base if you're only accepting cash. So to kind of start with, if we're saying I'm the company, I'm going to recognize a receivable whenever somebody pays for something to me on account. So they show up, they buy something from me, I don't get the cash for it yet, but I'm going to build and recognize an accounts receivable, meaning that I don't have the cash right now, but I expect to receive this amount in cash at a later date, okay? So you expect to receive this amount later in cash. That's a receivable. And think about a bull means it's going to happen, right? So you're going to receive it sometime in the future, okay? So you can kind of think about it like that. Where on the other side, let's pretend like we're the person approaching the company, wanting to buy something from them. Well, I don't have the cash on hand right now, but I think that with whatever I'm going to buy from them, maybe I can take that and go make a lot of cash with it. Or I know I'm going to have the cash really soon. Just the nature of our operations makes it so I don't have a large surplus of cash on hand right this second, so I can just buy something from them with cold hard cash. So what I'm going to recognize is a payable, meaning that I'm going to owe this amount to whoever I purchase this from in cash at a later date. So you owe this amount later in cash, okay? So we're going to make this a pretty brief video because accrual accounting is one of the most fundamental aspects of accounting, yet it's something that we often tend to struggle with because what we said before, revenues and expenses aren't synonymous with cash going in and out the door. It's simply the case that we're putting it on your tab so that we can recognize the cash later. So think about it like this. With the seller, if I'm going to recognize a receivable, so somebody comes to me, I sell them a product, I provide them a service, I do something where they don't pay me the cash right now, but they're going to pay me later. What I'm going to do is debit accounts receivable, because receivables are going to be assets, okay? And the way you increase the balance in an asset account is that you debit it. So I'm going to debit my accounts receivable, thus increasing the balance in that account, going, okay, this accounts receivable represents the amount I expect to collect in cash from everyone I sold these products to at a future point in time. And thus, I'm going to recognize revenue as well. You can almost think about it like you're substituting accounts receivable or you're substituting cash for accounts receivable on the front end. Pretend like they came to us and they did give us the cash. Well, what would we do then? We're recognizing the cash. We would have debited cash because we would now have it, and we would still credit revenue. The only thing that's different right here is that we're not getting the cash quite yet. We're going to get it at a later point in time. So for right now, I'm just recognizing my receivable, and I'm going to recognize my revenue. And then at a later point, once we actually collect it, what we're going to do is I'm going to recognize my cash, right? I now have cash once they do come forward and go, hey, thank you for putting that on my tab. I'm paying off my tab now. Here's the cash. We're good to go. I go, okay, awesome. I'm going to recognize my cash just for some dollar amount that they paid it for me, and I'm going to reduce the balance in my accounts receivable. Because I no longer expect to receive it. It's not receivable, it's received. So that's what happens from the seller's perspective, whereas from the buyer's perspective, what happens is I approach a company, I go, hey, I want to buy this product from you. They okay, awesome. I don't have the cash right now, but put it on my tab, I'll pay you off very soon. They go, okay, that sounds great. So I'm gonna recognize an expense on the front end, right? Because again, pretend like we're just replacing cash with a payable or a receivable, depending on if you're the buyer or the seller. In this case, I'm basically replacing it with a payable. I'm recognizing that, hey, cash isn't going out the door right now. I didn't give you green dollar bills, so I don't get to credit cash right now because I still have cash in my account. Like it hasn't gone out the door. I'm not going to decrease the balance in something that didn't decrease. But what I am going to recognize is a liability of an accounts payable. So payables are going to be liabilities, which thus increase with a credit, right? So I basically am getting this product, I'm recognizing the benefit I get from the product, so I expense it with a debit, I increase the balance in an expense account by debiting it, and I credit my accounts payable. And so at a later point in time, once I go, okay, awesome, I finally have the cash, let me go pay off the company that I bought this product from, I go, hey, thank you for doing that, here is your cash. So now my cash is going out the door. So what'll happen is that I'm going to credit cash, because cash just went down, right? And what I'm going to debit is my accounts payable, because that's a liability that holds a credit balance. So if it increases with the credit and I want to reduce the balance in it because it's no longer payable, I've paid it off. I don't want to recognize something that I still have to pay when I've already paid it. Then you're going to double pay it, and your books are going to be all off, and that's not even full with that. So in that case, it's just going to be an accounts payable debit right there. And that's pretty much the meat and potatoes of accrual accounting to start with. And you get into a lot of later transactions. What we'll talk about in the next video is something called an allowance for doubtful accounts, which is basically referring to the fact that not everyone is going to pay off their bills like they promised to. If I show up and go, hey, I'm going to pay you the cash later, you go, okay, awesome. They may ride off into the sunset and you don't ever get your cash. So what do you do in that situation? We'll find out in the next video.